Many investors don't like dividend investing because it takes too long to actually see results, which, if I'm being honest, I can personally understand. After all, it's really hard to get excited about something that may take 5, 10, 20, or even 30 plus years to build some real wealth, something to actually show for. But eventually, you're going to reach a point where all the progress from investing your hard-earned capital becomes noticeable, and moreover, you're actually really proud of yourself for what you've accomplished. So, I don't want you to quit before this dividend miracle happens, and therefore, I wanted to just share with you the one dividend investing secret that has made all the difference for me on my journey as a dividend investor. Now, the reality is, a dividend investor can really go down one of three paths. The first path leads to investing into dividend stocks with an insanely high dividend yield, but that usually comes at the expense of the overall capital growth. Examples here could be, say, companies like Verizon or Philip Morris. Now, veering down the alternative path, path number 2, it's actually the flip side of this script, whereas an investor may find him or herself investing into dividend stocks without much of a yield, yet plenty of growth, which may lead to shockwaves of volatility from time to time. Think about some of your tech stocks that show out a mighty small dividend, but leave you on a roller coaster ride and ultimately give you plenty of growth. And then there's the investor who tries to avoid both of these paths or this whole dilemma entirely by simply investing into SCHD purely because it's known as the holy grail to dividend investors. Now, there's honestly really nothing wrong with this third path, which is this SCHD approach. And eventually, when I am no longer in a position to take on a whole lot of risk and really need cash flow for income, I'm likely going to reallocate a lot of capital into SCHD. However, right now, just given my age and the amount of time that I actually have to spare in the stock market, it really doesn't make a whole lot of sense for me to invest into SCHD. And if you also have decades to go before you retire, well, chances are you're not quite there at the SCHD gates just yet. So here we are right back at this fork in the road to try to decide if we should chase yield or forgo it entirely. But this leads me now to the one secret to successful dividend investing that no one's really talking about. You need to change your entire perspective on dividend investing. And instead of squarely focusing on a company because it pays a dividend, learn to focus on high quality companies that just so happen to pay a dividend. It's with this approach that has honestly changed the dividend investing game for me entirely. And I can honestly say that if I didn't change the way I actually looked at dividend stocks and evaluating these companies, I simply wouldn't be sitting on north of $217,000 just in my brokerage account alone. Now, if I am not necessarily focusing on the dividend, then what exactly am I even looking for? Well, companies that dominate their industry and continue to actually disrupt their respective industries with new technologies or advancements. Secondly, I look for companies that maintain their reputation with a strong brand name. Ultimately, companies that the masses of all of us consumers have positive associations with. And finally, most importantly here, clean balance sheets. Whereas a company has little to no debt and I don't need to worry about financial troubles, at least in the near term. Now, in order for you to really understand what I'm even talking about, I wanted to run through 5 of my personal dividend growth stock picks that overall, at least in the last 5 years, have all proved themselves very well, outperforming the almighty SCHD, which we just called the holy grail of dividend investments, and you'll see it there in blue. So let's kick off into this list with Visa, ticker symbol V, up first, which is a company that I've been talking about rather recently non-stop because of the antitrust lawsuit that it faces after the Department of Justice came after Visa for the monopolization-like control that Visa has over smaller merchants. But I'm not here to get into the politics of that business. I'm here to talk about the future of it. And ultimately, an understanding that Visa is a transaction facilitator and credit purchases only becoming more of our accustomed norm, I really can't see a world without Visa. I can only see a world with a more advanced Visa. And despite the heat from antitrust lawsuits as well as the wonky consumer spending habits this past year, Visa still performed quite well, up overall 8% on the year. And clicking to the 5-year view, up over 60%. Now, scroll down with me to see the healthy influxes of revenue year over year. And more importantly here is this balance sheet, which is completely shored up with over $90 billion in assets with just $51 billion in liabilities. And if we're here to talk dividends, Simply Safe Dividends rates Visa a 99 99 in terms of a safety score, an all-powerful 0.74% dividend yield as the company continues to shell out a 22% payout ratio. Quite low for most companies while delivering through on 15 years so far worth of dividends to shareholders. And have a look here at this growth rate, an almighty 18% year over year on average growth rate there. So very powerful in terms of continuous growth. Now it is looking reasonably valued right now according to Simply Safe, but if Visa doesn't quite catch your attention, you can find gold in another man's trash, as the saying goes, with Waste Management, ticker symbol WM. Now talk about a company that is not so sexy yet insanely lucrative. Well, here we are. Now this industry, waste management and disposal, is actually booming, especially as we move into a desired greener future. And with waste management being really only one of two companies within the United States that's dominating trash pickup, recyclables, and dumpster rentals, this is really a no-brainer of an investment in my opinion. And it's also a company that we literally would not be able to live without. Now, we are going to see nothing but greenery here in terms of the stock chart, nearly 20% up on the year and over 82% up over the last 5 years. Scrolling down, we're going to see plenty of revenue flowing into the company year over year with their balance sheet that remains equally as clean. However, it's the dividend metrics that keep me highly attracted to this diamond in the rough, or trash I should say, with a safety score of 74 and comes down to a 1.41% dividend yield. Seems quite low, but I want you to continue to scroll down with me. We got a 42% payout ratio, and then we have 24 years worth of a dividend streak, all while delivering through on a monstrous growth rate here of 33%, not to mention another reasonably valued pick according to Simply Safe Dividends if you're interested in investing into it right now. Next up, I want to talk healthcare, more specifically health insurance with United Health. That's ticker symbol UNH, which is one of the largest, if not the largest, healthcare providers within the United States, where if we just get really honest here, you can't go without coverage, yet it's going to remain astronomically expensive. So a catch-22 here that benefits all of us investors. But we're going to remain neutral on politics. We have a beautiful and worthwhile dividend investment on our hands. You can see it's up over 12% worth of growth at least this past year. And clicking to the 5-year view, we're going to see over 146% worth of appreciation. Now, in terms of United Health's income statement, revenue on revenue year over year, all while the balance sheet remains shored up with assets coming in as high as $271 billion in 2023 alone, while liabilities lie around $174 billion. Now, if we go to Simply Safe Dividends, we're going to find another dividend stock scoring a 99 in terms of safety while delivering through on a 1.39% dividend yield. Scrolling down, we're going to discover a payout ratio at just 29%, while the company has been on a dividend streak for the past 31 years. But get this, an average growth rate over 41%, and once again a reasonably valued stock, at least according to Simply Safe Dividends as we speak right now. Now investors, I have two more very powerful, high quality dividend growth opportunities to put on your radar. But before I actually cover them, I want to go ahead and level with you real quick. I have to share that I'm in need of your help. You see, about 70% of you watch these videos, tune in weekly and daily even sometimes, but you're not subscribed. Now, I would love to chop that number down to at least 50%, but that requires your help. I want to know I made the right decision in quitting my corporate job. So join the journey right now here by subscribing. You're just going to continue to get stock ideas, macro news bites, money talks, and masters of the market chats. And while you're at it, let me know that you're actually getting value from this video. That's all you got to do there is actually tap on that thumbs up button. Now with that, we'll jump right back into it. We're going to talk about Deere, John Deere that is, that's ticker symbol DE, which is the world's go-to agricultural machine and tractor manufacturer that hasn't been dealt an easy hand over the last few years, with interest rates where they were and inflation eating away at the value of our dollar. Yet Deere prevailed, only up nominally this year, but let's go ahead and click to the 5-year chart to see it's up over 134% in terms of appreciation. We'll scroll down here to see a very powerful company with annual revenues that consistently trump previous years of theirs. And in terms of their balance sheet, well, we remain on par there as well. Whereas assets far outweigh their liabilities this past year, coming in at $104 billion in assets with just $81 billion in liabilities. If we head over to Simply Safe Dividends, we're going to see another powerful safe bet coming in with a strong safety score upwards of 83 and a dividend yield at 1.44%. Now coming down, we're going to see a payout ratio sitting around 20%. Again, not so much in comparison to industry peers, years, along with a dividend streak that's been ongoing now for 30 years, all while experiencing an average growth rate when it comes to Deere at 13% year over year. And as of this video, we're going to see here that Simply Safe Dividends actually rates Deere as an overvalued pick, so put that on your radar as is. But investors, if there's one stock that since day one I have been bullish on and continue to be bullish on as a dividend growth investor, it's been Apple. Of course, I don't need a big introduction, and I also want to share that if Microsoft is more of your deal, it's also a solid pick, but for me, I'm an Apple fanatic, so I'll let you do your Microsoft research on your own. As for Apple, we're talking about a company that truly is thinking differently to disrupt the world's way of thinking, at least technologically speaking. And for all those of you who feel that Apple is done growing because their product isn't changing all too much, or at least hasn't been over the last decade or so, I think you're dead wrong. And it's precisely because of Apple's sleek, familiar products that keeps it very relevant. But the newest announcement with Apple when it comes down to AI will be huge, and full integration isn't even going to take place yet for, I think, another handful of years. So more announcements to come that will surely make stock pop off once again to higher highs. Now, clicking into the stock chart, we're going to see that Apple soared by 24% this past year, and over the last 5 years, a staggering 291+% worth of share price appreciation, despite all the economic troubles. Now, in terms of annual revenues, Apple is just batting home run after home run year after year with revenue that continues to flow in, and it's maintaining a very squeaky clean balance sheet that holds it together in terms of one of the largest market caps we've ever seen. However, if we're talking dividends, we will click over to Simply Safe Dividends. We'll see another 99 safety score, smaller yield that comes in at 0.43%, all while maintaining a 15% payout ratio with an 11-year dividend streak, and coming in strong with a 9% growth rate on average. However, I gotta let you know it's overvalued, at least as of this video. But investors, the big secret here to invest into quality dividend paying companies, not just for their dividend, but for actually what they deliver through on year in and year out for decades worth of time, is the most important factor for all of us dividend investors. Of course, that path, if we choose to think about dividend investing like this, ultimately does lead to you investing into higher yielding dividend stocks, but only at the right time. And that time comes when you don't have a lot of time nor the ability to risk in the market. So all in all here, go for companies that are high quality companies that just so happen to pay out a dividend, not just investing into companies because they pay out a dividend. That's the big secret. That's what's made all the difference for me. I'd love to know what has changed the game for you in terms of your dividend investing secrets. So let me know down in the comments below. Now, if you're looking to avoid some of the mistakes that I personally made as a dividend investor that really held me back, click into this video right here. But before you click away, subscribe to the channel and I'll catch you in the next one.